Topic 4. Capital Allocation Framework. Capital allocation is one of the most important strategic responsibilities of the Chief Financial Officer, CFO, and executive leadership team. It determines how an organization's limited financial resources are deployed across competing investment opportunities to maximize long-term enterprise value. While capital budgeting traditionally focused on project evaluation, the modern capital allocation framework provides a comprehensive governance process that integrates corporate strategy, financial discipline, risk management, sustainability, and shareholder value creation. Organizations that consistently outperform competitors are often distinguished not by how much capital they possess, but by how effectively they allocate it. A capital allocation framework begins with strategic alignment. Financial resources should support the organization's long-term strategic priorities rather than short-term financial objectives alone. Whether the enterprise seeks market expansion, digital transformation, operational excellence, product innovation, acquisitions, geographic diversification, or sustainability leadership, capital investment decisions must reinforce these strategic ambitions. The CFO plays a central role in ensuring that every major investment contributes to corporate strategy, while generating acceptable financial returns and strengthening competitive advantage. The first component of an effective framework is capital prioritization. Organizations face numerous competing demands for investment, including organic growth projects, mergers and acquisitions, technology modernization, research and development, infrastructure expansion, human capital development, ESG initiatives, debt reduction, and shareholder distributions. Since financial resources are finite, executive management must establish disciplined criteria for prioritizing investments based on expected value creation, strategic importance, risk exposure, and resource availability. Capital allocation, therefore, becomes an enterprise-wide strategic decision rather than a purely financial exercise. Financial evaluation provides the analytical foundation for capital allocation decisions. CFOs employ methodologies such as discounted cash flow DCF, net present value NPV, internal rate of return IRR, economic value added EVA, profitability index analysis, and scenario modeling to compare investment alternatives. However, advanced capital allocation extends beyond traditional financial metrics by incorporating qualitative factors such as customer impact, innovation capability, digital transformation potential, sustainability objectives, organizational capability building, and long-term strategic positioning. This balanced approach enables organizations to invest in initiatives that may generate substantial future value even when short-term financial returns appear modest. Risk-adjusted decision-making is another essential principle of the capital allocation framework. Every investment involves uncertainty arising from market dynamics, competitive actions, regulatory changes, technological disruption, geopolitical developments, inflation, and macroeconomic conditions. Modern CFOs integrate enterprise risk management into capital allocation by conducting sensitivity analysis, scenario planning, stress testing, and probabilistic forecasting. Investments are evaluated not only for expected returns, but also for their resilience under alternative economic and business conditions. This disciplined approach improves strategic decision quality while protecting shareholder value. The framework also addresses capital allocation across the corporate lifecycle. Early-stage growth companies may prioritize innovation, market expansion, and customer acquisition through aggressive investment and equity financing. Mature organizations may focus on operational efficiency, dividend distribution, debt optimization, and selective acquisitions. Companies undergoing transformation may allocate significant capital toward digital technologies, automation, artificial intelligence, and business model innovation. Consequently, optimal capital allocation evolves alongside changes in corporate strategy, industry dynamics, and economic conditions. Digital technologies are significantly enhancing capital allocation capabilities. Artificial intelligence, advanced analytics, predictive modeling, cloud-based planning platforms, and integrated enterprise data systems enable finance leaders to evaluate investment portfolios continuously rather than through periodic budgeting exercises. Real-time financial and operational data allow organizations to monitor investment performance, identify underperforming assets, reallocate resources dynamically, and respond quickly to changing market conditions. Digital finance transforms capital allocation from an annual planning process into a continuous strategic management capability. Environmental, social, and governance (ESG) considerations are increasingly integrated into capital allocation decisions. Investors and stakeholders expect organizations to allocate capital toward initiatives that support climate resilience, responsible supply chains, human capital development, diversity and inclusion, and sustainable innovation. Green infrastructure investments, renewable energy projects, sustainable manufacturing technologies, and digital efficiency improvements often generate both financial returns and long-term stakeholder value. CFOs therefore evaluate investments using integrated financial and sustainability criteria to support responsible corporate growth. Strong governance is fundamental to an effective capital allocation framework. Boards of directors and executive committees establish investment policies, approval authorities, portfolio review processes, post-investment evaluation mechanisms, and performance monitoring systems that ensure accountability and transparency. Finance functions support governance by providing objective analysis, independent challenge, and ongoing measurement of investment outcomes relative to strategic objectives. Ultimately, the capital allocation framework serves as the strategic bridge between financial resources and enterprise strategy.